following is a Silver Bullion Television audiocast. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Our guest today is Matt Geiger, Managing Partner of MJG Capital, a limited partnership focused on long-term capital appreciation through investments in natural resources. And we're delighted to have him here today as our guest. Good day, Matt, and welcome to SBTV. How are you doing?
Thanks for having me, Patrick. It's good to be on the program for the first time, and I'm looking forward to discussing the electric vehicle market, the lithium-ion battery revolution, and the metals that make this possible.
Yeah, great. We're really happy that you could join us and help explain it to our listeners. A little bit about you. Could you share with us your background and how you got into the resource industry?
Certainly. So I'm a younger guy, still have not hit 30 yet. I'm based out of San Francisco, and I grew up in kind of the haven of tech. And so natural resources and mining in particular is looked down upon as a stodgy and old-fashioned industry. But in my opinion, that couldn't be any farther from the truth. Particularly given that all this cool high-tech technology that we're dealing with nowadays, whether it's your smartphone or electric vehicles or rockets going to Mars or what have you, it all takes natural resources and it all takes metals, high-tech metals. These are the building blocks of our 21st century lifestyle. So it's always been a great passion of mine. It's a contrarian industry, which I appreciate as well. That fits my nature, and I also know it's going to be relevant for the next 60 to 70 years, as long as I'm alive and investing. And as long as global population is growing exponentially, and as long as consumption on a per person basis is growing exponentially, if you can take a long-term time horizon, I think this is a great place to be. So it's an industry I'm very passionate about. And in some ways, while I'm off the beaten path in San Francisco and there aren't too many mining investors around, there's a small group of us that stay in very close touch and exchange ideas, and I appreciate the few others in the Bay Area that are focused on the same space that I am. And then there's also a lot of money available, especially from tech. So in some ways that's an advantage because it's a unique focus of mine, at least relative to my peers. So things are good.
I read with great interest an article that you wrote back in February titled "Nickel, Is It the New Lithium?" And before we talk about nickel, I'd like to talk about the electric vehicle story. There's been significantly more news now about the growth of the EV market or electric vehicle market, more so than years before. And it seems that the electric vehicle story, it's rapidly catching on. And for our listeners who may be new to the EV story, could you share with us how big this trend will be?
Sure thing. So I am a believer in the EV story. I wouldn't say I'm a born-again convert. I don't think we're going to 100% electric vehicles tomorrow. But I do think the consensus view of 15% EV adoption by 2025 is a reasonable barometer. And if that ends up being the case, then investors in the raw materials that go into these electric vehicles are going to be very happy. If anything, though, that could be underselling the story. And there's quite a few reasons for that. I guess if you look at the estimates of some of the major car manufacturers globally, there are a couple interesting data points. You have Volkswagen, who is the largest producer of cars globally when you look at their three wings, who expect 25% of their sales to be EV by 2025. So that's well in excess of the consensus view, and I think that's something to keep in mind. You have groups like Volvo, who by 2019 are going to be 100% electric or hybrid. So they're moving even more quickly, and I find that pretty fascinating.
2019, that's next year.
Yes, it's out. Yeah, so they're going to have no more ICE models, which is shocking. And then you have companies like BYD, based out of China, where Warren Buffett's a big investor, and their chairman, he's admittedly talking his own book, but he's saying that he thinks they'll be 100% electric in China by 2030.
Wow.
So the car manufacturers, who obviously know this better than me, are feeling very bullish on the electric story. So consumer preferences are changing. Consumers are more amenable to this. We know that within 3 to 5 years, it will be cheaper on an all-in basis to buy an electric vehicle than a standard internal combustion engine or ICE vehicle. And so you have market forces and economics that are pushing us in this direction. But then you also have governments that are also nudging us towards an all-electric future. For instance, China has set a goal for 20% of its auto sales to be fully electric or a plug-in hybrid by 2025. So that, again, is above the 15% EV consensus by 2025. And China, I might note, as a quick tangent, they aren't doing this out of the goodness of their own hearts. They're not doing this because they're total greenies or want to prevent global warming. This is a political issue. And as long as these Chinese citizens, if you spend a day outside on some of the worst air days in Beijing, it's the equivalent of smoking 2 packs of cigarettes. And that's not tenable from a political standpoint. So this has to do with reducing the amount of particulates in the atmosphere and the amount of pollution so that the Communist Party can stay in power. So there's a real practical reason for them to be pushing in this direction, both with cars and buses and what have you. China does not like to be dependent on anybody for resources, and oil has always been their Achilles heel. They're plenty endowed with many other metals and basic materials within their country. But oil that's not the case. So that's another reason for them to be pushing in that direction. In the EU, a little less surprisingly, but you have countries like UK and France that are saying they will potentially ban all new gas and diesel cars starting in 2040. So that's only 2 decades away, and who knows, that timeline could be slid further forward. Well, that remains to be seen. And then you have places like California, are of course more progressive. But generally, in terms of technological adoption, seem to lead the world. And just earlier this year, you have $2.5 billion that were set aside to subsidize electric car purchases. So many of the global governments here are pushing us in this direction. So that, combined with the economics of owning an electric vehicle, makes the future seem very bright. So I will just say that as an investor, it's impossible to know the exact pace of the trend, the exact pace of adoption. There's so many variables, there's so many wild cards here. But just know that if you're willing to take a 5-year time horizon here, the trend is on your side as an investor. And there's also the chance that there will be an upside surprise and adoption will happen quicker than people think. And that's all gravy if you're positioned in the space.
I'm pretty sure that a lot of our listeners, they're car owners themselves, and but it wouldn't surprise me if a lot of them may not be familiar with the proposition to switch over from an internal combustion engine to an electric vehicle. And I think what's key to the adoption of a new trend is if the narrative resonates with consumers. And do you think electric vehicles are an easy sell to consumers?
I do. I think the pace of adoption is showing that. For instance, you've seen just in China, focusing on one of the bigger car markets in the world, on a monthly basis, we're seeing incrementally more and more vehicles being bought that are electric. So for instance, just in September, a couple months ago, the percentage of overall vehicle sales that were EV were right around 5%, and estimates that just next month it's going to be close to 7%. So I think people are doing it, and at the moment, a lot of it could be the novelty of a new technology or the ideal of saving the environment or what have you. But as I mentioned, in a short time here, it's going to economically make sense to own EVs, and I think that's the real tipping point. And that's going to happen within the next 3 to 4 years. Economically,
that'll help move EVs along, but the power and the driving range and speed, are they comparable to internal combustion engines?
Well, I mean, they're continually improving, right? And ultimately, I don't know if tomorrow we could see 100% replacement of ICE vehicles with EVs. But for the majority of people on a daily basis, you're driving well within the range of these EV vehicles. And obviously, there's a spread across the spectrum of different ranges, different technologies, depending on which car manufacturer you're looking at. But this is something that they're working on, and they have been for 10 years, and it's going to become less and less of a problem. And additionally, infrastructure is being built out. And as that happens, people are going to be able to get where they want to go with EVs.
For all this to happen, governments definitely have to be supportive of electric vehicles and the car manufacturers as well. But a key piece of the technology to the electric vehicle is the lithium-ion battery, and it's a technology it's been around for quite a while, but perhaps only within the last decade or so it's been seriously used in a vehicle. Wait, hang on, wasn't an EV that went by, but anyway.
I guess not.
But could you share more about how the demand for these batteries is at this moment? And is there a race going on to build more of these batteries?
Sure. Well, we've been focusing on EVs so far, but I do think it's important to take a quick step here and talk about in terms of lithium-ion adoption. EVs are only half of the story, and another big aspect here is grid storage. And the reason this is important is as wind, solar, and other alternatives continue to increase in the overall share of power generation globally, we're going to need storage, because ultimately the sun doesn't shine 24/7, wind doesn't blow 24/7, and that's the main detraction from these alternative sources, is that they're not baseload. They can't run around the clock. But that problem can be largely mitigated by using batteries on a grid basis. So lithium-ion batteries are going to be battling for supremacy in this grid space against a couple other technologies. That said, there are quite a few factors working in favor of lithium-ion batteries from a grid storage perspective. The first is that over the past 10, 15 years, there's been exponentially more R&D resources, time, money being put into lithium-ion battery research. And I mean, that's driven us to where we are now. That's why you've seen the cost of these batteries plummet pretty dramatically over the past 10 years. And I expect that to largely continue. So that's a huge aspect. The more eyeballs and the more money you have focusing on a given technology, the quicker it's going to advance. And a second issue, which has become particularly relevant just in the past couple of years, is that vanadium prices, over the past 18, 24 months are up close to 1,000%. Right. So for investors in vanadium, I mean, that's a positive, of course, but you also run the risk of these rapid price rises cannibalizing demand for vanadium redox batteries in the future, or discouraging researchers to even focus on improving the technology because they're worried about the inputs. And I don't have the exact numbers in front of me, but in terms of the percentage of the cost of the overall battery, lithium is a much, much smaller percentage. So the price could increase pretty substantially without it affecting the overall battery. Whereas for vanadium redox batteries, a move like this has a substantial impact on the overall cost of the battery. And so that could stunt growth in the industry. So, long story short, it's going to be a dogfight between these two technologies. There's a few others in the mix as well. I don't think there's going to be an obvious winner on the grid storage space, but lithium is going to be a definite part of the mix for the foreseeable future.
The storage space that you're talking about, these are separate from the types of batteries that will be used for electric vehicles, correct?
Sure. I mean, they're much larger scale, right? So I guess that's one of the advantages of lithium-ion batteries and why vanadium redox would never be used in cars, just due to the weight and the actual size. But in terms of the chemistry, from a lithium perspective, they'd be very similar to what are going in cars. It would just be much larger batteries and much higher capacity.
Talking about the composition of these batteries as it goes to, let's say, back to the electric vehicles, lithium ion is definitely one of the components. But the other two specifically people are looking at would be cobalt and nickel. Would I be correct?
Yeah, absolutely. I can quickly run through kind of the commercial history of lithium-ion batteries here. They first became available in the 70s, but it took multiple decades for them to become the preeminent battery type globally, which has just happened within the past decade. You really have three components of these batteries. You have the cathode, the anode, and the electrolyte. So the electrolyte is where the lithium comes in. Usually it's a lithium salt in a solid gel or liquid form, and that's kind of the transitor between the cathode and the anode. The anode is traditionally graphite, and I think it will remain that way for the foreseeable future. It's split roughly 50-50 in terms of natural graphite and synthetic graphite going into the anode. And then the focus, my investing focus is mainly on the cathode. And there are competing chemistries or cathode chemistries, but especially over the past couple years, the nickel manganese cobalt chemistry, or NMC, has come out on top. And in that article you referenced earlier this year, I deem them the king. NMC cathodes is the king of the cathodes, and that will be used predominantly going forward. So now focusing specifically on NMC cathodes, within the actual chemistry there's a seismic shift underway. And these batteries are becoming more and more nickel rich. So the original NMC cathodes from 5 or 10 years ago were generally 1 part nickel, 1 part manganese, and 1 part cobalt. So roughly 33% by weight of each of those metals. But they're shifting strongly towards more nickel heavy chemistries. So nowadays the majority of commercially produced cathodes see either a 5-2-3 or 6-2-2 chemistry, with nickel having the heavier weight. And within a few years, we're going to see the composition of these cathodes switch to 8 parts cobalt, 8 parts nickel, 1 part manganese, 1 part cobalt, and maybe even beyond that. There are talks of a battery where it's 9.5.5, so 9 parts nickel, 0.5 parts manganese, 0.5 parts cobalt. And just a couple of days ago, there was a good Bloomberg article that came out about the battery companies Johnson Matthey and BASF have licensed technology with a London-based startup called CAMX Power, where they think they can get down the chemistry to 9.2 parts nickel, 0.4 manganese, 0.4 cobalt. So, by weight, only 4% of the battery would be cobalt, 4% manganese compared to 90% nickel, 92% nickel. So these are pretty dramatic changes. And kind of the reasons behind the switch to kind of a nickel heavy chemistry, there are a few of them. The main one I would say is just price. Nickel is substantially cheaper than cobalt. Right now it's roughly one-sixth the price. So the economics make a lot of sense to shift to nickel heavy chemistries. Additionally, there's really very minimal child labor concerns associated with nickel production, whereas cobalt, that's a really big deal, especially for these global brands that have pretty massive CSR obligations and don't want to taint their brand with the risk of using conflict cobalt or cobalt mined by child labor. And in the nickel market, that's not nearly as big of a problem. I mean, it's not a problem where for cobalt, that's become a mainstream worry. And it's well known kind of in the investment community and even amongst consumers that if you're consuming something with cobalt, there's a chance that it was produced by child labor.
Right.
And then additionally, there's just nickel supply is more geographically diversified just by how the geology has worked. And so you don't have to depend on the stability of a country like Congo or where 60% of cobalt is produced globally. And it just it minimizes supply chain risk, which is a big deal to these producers. So, I still am a believer in cobalt. I think it's a good investment over the next 4 or 5 years, medium-term time frame. And particularly in the short term, I mentioned that 60% of cobalt production is coming out of the Congo. Right. One of the biggest miners there is called Katanga Mining, and they produce around 10% of cobalt supply globally. They just announced earlier this week that they're shutting down production for 1 to 2 quarters. They interestingly found uranium or radiation within their ore, which was not expected and which was a surprise. So now they're going to have to install a $20 to $30 million ion exchange unit in order to separate out the uranium before they process the cobalt. So that's going to suspend production for 1 to 2 quarters. And at least in the near term, I think the cobalt market's been quite soft this year, which has surprised a lot of market participants. But I think this could be the catalyst that gets eyes back on the story. So, look, my preference is definitely focus on nickel. I think that's going to be the big long-term winner of kind of the battery revolution that we're undergoing here. But I still do believe in cobalt. I think it's going to be very difficult to get cobalt entirely out of batteries. And, especially with some of the near-term developments, cobalt could do quite well.
We've been talking quite a bit about nickel and cobalt. For the benefit of our listeners, could you explain the role of nickel and cobalt in the lithium-ion battery?
Certainly. Yeah, so nickel is more from a storage perspective in the cathode. Cobalt is extremely helpful with stability and in limiting the concept of thermal runaway. You don't want any exploding batteries like we saw with the Samsung Galaxy X3s a couple of years back. That is no bueno. So that's cobalt's role. And so that's one of the big worries amongst these battery manufacturers as we shift to chemistries with less and less cobalt, is that the actual stability of the battery is going to decrease. And so that brings me to one slight tangent here, but one interesting phenomenon we're seeing that's just starting to gain steam is that as cobalt is being largely taken out of the battery, and stability starts to become a worry. Mm-hmm. We're seeing a material called high purity alumina, or HPA, being used as a coating on the outside of cathodes and on the outside of anodes, basically as almost a replacement for this stability. So demand uses for high purity alumina currently, LED demand takes more than half of the market. Semiconductors, phosphor-based applications are around 20% each. A very new source of demand has been sapphire glass, which is basically kind of the glass that you'll see on smartphones and kind of high-tech touchscreens. And now, as a coating on the cathode, that's a new phenomenon as battery makers try to find a replacement for the stability that's being lost by taking more and more cobalt out of the chemistry. So that's something to keep an eye on as an investor as well.
Going back to nickel, I understand that the nickel market can be divided into class 1 nickel and class 2 nickel. And I understand that only class 1 nickel is usable for battery production. Could you give us an overview of the nickel market? How big is the class 1 nickel market compared to the class 2 market?
Certainly. And this is vital to touch on because not all nickel is created equal by any means. And you do have to differentiate between, as you said, the class 1 nickel and the rest of the market. So roughly only half of the global nickel market is suitable for use in batteries. The two types that aren't are ferronickel and nickel pig iron, often referred to as NPI. Those are not feasible for battery use. It's either chemically impossible to use in batteries or the costs are just extraordinarily prohibitive, where it's not even worth considering. And so those will continue to be used as alloying agents in the production of stainless steel going forward. So that means that the battery grade nickel is restricted to nickel sulfide deposits, and laterite deposits that are basically referred to as limonitic laterites. And these can produce class 1 nickel through HPAL, or high pressure acid leaching. So today, roughly 80% of class 1 nickel production comes from sulfides, and the balance comes from these HPAL limonitic laterite operations. However, this is going to shift pretty substantially in the coming years, because if you look at the total nickel resources globally, only 4% of them are high-grade sulfide. So there's a real lack of quality, large, high-grade sulfide deposits globally. And so, sulfides are preferable for class 1 nickel production. It's easier. In terms of, if you look at HPAL, it's more of a chemistry experiment, and all HPAL laterite deposits are created differently. So there's quite often a long ramp up in terms of starting new production, because it needs to be tinkered with and optimized, and it's not easy. Some would consider it a chemistry experiment. But the world will have to rely on these HPAL operations going forward to meet the pending Class 1 nickel demand that we're going to see. So if you're looking at the ferronickel names, NPI, I would avoid those entirely. There's plenty of latent supply in places like Indonesia. So if you see nickel prices start to rise, that demand can come on stream pretty quickly. And really the way to start thinking about this is we're going to see a bifurcation of price in the market between the Class 1 nickel and then the non-battery grade nickel. And so from an investment perspective, I think it makes a lot of sense to focus on the limited number of sulfide deposits globally, and companies exploring for the next big world-class sulfide deposit. And then also, focusing one's attention on the advanced limonitic laterite deposits, which are, advanced and, potentially could produce in the next 3 or 4 years in places like Australia and Brazil, which is generally where these types of deposits are found.
Yeah, I was just meaning to ask you about the price of nickel. Class 1 nickel has its specific uses. Class 2 nickel has its uses. But there seems to be, or there is, just one nickel price.
Yes, at the moment. But I think that's subject to change. And I wouldn't be, you are seeing a premium nowadays assigned to Class 1 nickel, and that premium is growing. But it makes sense eventually for them to be priced entirely separately, because I do think you're going to see that premium continue to widen, because there is limited sources out there for battery grade nickel, and there's plenty of latent supply, as mentioned, for nickel used for lower value uses like stainless steel production.
Right.
And that gap will widen. And eventually the LME or somebody out there is going to decide, well, it doesn't make sense pricing these the same anymore, because the premium that people are paying is so large that it's really two distinct markets.
In your opinion, the Class 1 nickel supply, is it sufficient for the expected demand coming from EVs, or are we really going to have to start refining?
It's a good question. I will say definitively that lithium will never, ever be the bottleneck in terms of battery production. There's plenty of lithium out there. It's hard to access sometimes, hard to produce, but there's no lack of lithium supply. Cobalt would become the bottleneck if we stuck at the current battery chemistry right now of 523 or 622 and just stuck with it for the next 10 years. We'd run into problems with cobalt supply in the next 4 to 5 years, and that would be the bottleneck in terms of increased battery production. But given the trends we're seeing towards 811 and even further, like extremely nickel rich chemistries, I do believe that nickel will be the bottleneck sometime in the next decade. And so that's the metal that ultimately is gonna get the most attention. But it's going to take some time. And a lot of people ask, why has the nickel price not seen the huge gains in recent years, like lithium and cobalt? Why hasn't there been hype around it? And I think that will change. I think nickel has not had its time in the sun yet, but that will change. However, there are a few reasons why it hasn't gotten the same excitement. I'd say the first is that there's simply less there's less sex appeal surrounding the nickel, despite the positive dynamics we're seeing with the changing chemistry. Lithium moved first. It's a niche metal. It's a small market. Close to 50% of I think it's 40% of lithium demand actually goes into batteries. And from a retail perspective, something as simple as having the name lithium in the name lithium-ion batteries can literally make all the difference. Elon Musk, would beg to differ, and he's on the record saying that these batteries should be called nickel-ion batteries, which I think tells you all you need to know. But from a brain-dead, perspective, lithium's the first place to look. It's an obvious bet. And cobalt also has that sex appeal that generates headlines. It's a rare metal. Again, it's a small market. 60% of the supply comes from one country, the Congo, which is easy to write about. And there's the chance of a supply disruption if anything goes wrong in the DRC. And then you also have that persistent child labor that we touched upon earlier, which generated a lot of attention. So I think that's one of the reasons why we haven't seen nickel move. A second is that a ton of investors have lost money on nickel in the past 10 to 12 years. And the investment community could very well be jaded by the metal in general. If you look at the price charts, nickel is off a full 80% off of its 2007 peak. So
Yes.
it's just way below water. Completely devastating to investors that have put money to work anytime in the past decade. You can compare that to copper and some of these other base metals. If you look at copper, it's off less than 40% of its last big peak in 2011, 2012. You can look at zinc, another base metal here, is off only 40% off of its 2007 peak. You could look at tin, which is off 35% of its most recent high. Even iron ore, which has had a really rough 3 to 4 years and is kind of viewed as being in the doghouse amongst many metals investors, is only off 55% of its 2011 peak. So the disparity in performance has been pretty notable, and nickel's been a big loser over the past 10 years. There's no doubt about it. I guess a third reason here, and this is going back to kind of lithium and cobalt comparison, the nickel market is much larger. So EV class 1 demand is a smallish percentage of the overall nickel pie. For cobalt, battery demand is already over 50% of total demand. And for lithium, it's nearing 50%. I think it's between 40 to 50% at the moment. Nickel, meanwhile, this is just at the moment. This will change. But it's an order of magnitude lower, where only 4 to 5% of current nickel supply actually goes into batteries. So that's another reason the EV switch and kind of the battery revolution we're seeing hasn't impacted the market in a big way yet. And I guess the final quick point that's worth mentioning is in the nickel space in particular, there has been a fair amount of above ground stockpiling of the material. As speculators look ahead to what's going to be a pretty big supply crunch. And thanks to groups like Silver Bullion, for instance, the investors are able to pretty easily store physical nickel. And so I think this hidden supply that's out there has weighed on the price and will continue to do so in the short term at least. I think this inventory, this above ground inventory, will be worked through. This is not going to affect the market in a big way in the medium to long term. However, in the meantime, we need to chew through some of this above ground inventory, as these aforementioned trends continue to gain pace. So I think those are some of the main reasons we haven't seen nickel portrayed in quite the same light as we have lithium in 2016 and then cobalt in 2017. But that will change.
Going back to 2007, I think nickel was more than 50,000 or so per ton. Right now, currently, it's 11 to 12,000 per ton. Still a long way from that 2007 peak. But do you think we'll see those 2007 prices again?
Well, it's a good question. I think it's possible. I think it's quite possible. I mean, one of the big variables this time is that there will be a bifurcated market. So I don't think we'll ever see NPI or ferronickel prices. I think about it generally on a per pound basis, so forgive me, but the current nickel price is in kind of the mid fives per pound, and the peak was around $24 per pound in 2007. So I don't think we'll see NPI or ferronickel approach the $20 range for decades, if ever. But in terms of battery grade class 1 nickel, especially as we kind of hit this tipping point in the coming few years where EVs start to make a lot more sense than internal combustion engines, and as these battery chemistries start reaching pretty extreme nickel heavy cathode, 8 to 1 1, 9 1 1, that's when we're going to see the price move. So I wouldn't expect it in the next couple years. If you're investing in companies, I think you don't want to plug in too crazy of prices, but I think things could surprise the investment community in a pretty big way.
Matt, are there any new battery technologies out there that may threaten the use of nickel in electric vehicle batteries?
Not in the next 10 years. Like I'm a firm believer that for even the long term, lithium-ion is here to stay, especially within the EV space. I mean, we touched on grid storage and how there's quite a few competitors there, but just the portability of lithium-ion batteries is unsurpassed by what else is out there. the amount of, again, R&D expenditures, the amount of time, money, and brain power that's being put into improving and optimizing these technologies. There's nothing else out there that compares right now. So, it's worth paying attention, seeing what other technologies are out there. You always have to be willing to change your mind if things change, but I'm operating under the assumption that this is going to be the EV market for at least 10 years and probably closer to 20.
How can investors get in on this nickel story? How can they invest in nickel, and what mining companies or nickel mining companies are currently on your radar?
Sure thing. So, there are a few ways. We touched on this earlier. You can go the physical route, and work with groups like Silver Bullion and hold nickel above ground, and with the idea of selling and cashing in when prices rise. That's the most direct way to play it. Obviously, you're going to get much less leverage relative to investing in mining equities. There are some sulfide deposits still out there in the hands of junior companies, and a few of them in North America and in Canada in particular, couple down in Australia as well. So that's an area to look. In terms of investments or how we have exposure, one of my favorite names, and again, this isn't a recommendation for your audience because everybody has their own, investment preferences and limitations and what have you. But Sama Resources has been a big winner for the fund. This is a company that's operating out in Ivory Coast and has a massive exploration package where it looks like the company might be on to the next world-class nickel sulfide discovery.
Wow.
So the company recently brought in Robert Friedland's group, HPX, and you'll remember that Robert Friedland was responsible for probably the greatest nickel discovery ever, Voisey's Bay during the 90s, which he ended up selling for $4.5 billion. Been plenty of books written about that. It's a phenomenal story. So Friedland's had experience in the space before. Him and his geologists looked at what Sama had on their hands and said, hey, this could be a Voisey's Bay 2.0. So that's what I'm really excited about. But ultimately, they have to make that big discovery. And if they don't, even if nickel prices quadrupled over the next 5 years, it will be irrelevant. So that's the risk. But I do like smart management teams who have experience in nickel sulfide exploration, working on exciting land packages, well-financed. That makes sense to me. Kind of Sama is towards the top of my list. And then I do believe that there is a space in the market for HPAL projects, so the limonitic laterites that I mentioned earlier. There are quite a few down in Australia. Some of the bigger names would be Cleantech. That's another Friedland company, actually. Ardea Resources, Australia Mines, and there are a few others down there. We're shareholders of Ardea Resources. Again, that's not a recommendation, but that's just how we're getting exposure to the HPAL story. I like Ardea. So it is leveraged. It's going to need higher nickel prices in order to make sense as a project. So generally, I don't like optionality plays. I like investing in projects that make sense at current metal prices. But I have so much conviction in nickel in particular that I'm willing to make an exception here. And the other thing I like about Ardea and some of these HPALs or HPAL opportunities is that Ardea in particular has a very high cobalt to nickel ratio. So you
nice.
can kind of kill two birds with one stone and get exposure to both of those metals. And so I think that in order to, even though these are a bit of a chemistry experiment, there is a lot of technical risk. We're going to need quite a few of these laterite deposits to come online in the next 5 years. And I think the three names I mentioned are in line to be those names to help bridge this lack of supply in the coming years as demand for Class 1 nickel really ramps up. So those would be kind of my recommendations for how to go about it. Either go physical, look at some of the existing nickel sulfide names that are out there, and there aren't many that are in the hands of juniors. Look for companies exploring for world-class nickel sulfide opportunities, and then also place a bet on some of the higher quality, later stage limonitic laterite deposits that will make a lot of sense if nickel prices are, move 50 to 60% over the upcoming couple of years.
Okay, and so if our listeners, they go over to your website at MJG Capital, they'll be able to find out more information there?
Absolutely. Yeah, I always love talking about, these trends that I'm seeing in the market. Love talking about our individual holdings. Always happy to share more information about the fund. I should have touched on this earlier, but very quickly, we're a limited partnership, fully focused on natural resources. We keep a very concentrated portfolio. We'll have only roughly 20 names in it at any given time. I have a limited bandwidth as a fund manager, and I want to know what's going on with each and every one of our stories. And then additionally, if something works out in a big way, I want it to move the needle for the whole portfolio. So I think having discipline and keeping a concentrated portfolio is extremely important in this industry, even though the temptation, because there's so many juniors, is to hold 40 or 50 or 60 names. I really believe strongly that you have to push back against that temptation and pick the best 15 to 20 at the very most. Roughly half of the positions that we initiate will be through private placements. So very focused on the private placement space, a big stickler for the terms. I like my full 3 to 5 year warrants, no acceleration clause. But we'll, and then about half of our positions will initiate on the open market as well, generally with high quality companies with at least 12 months of runway, if not longer. And right now we're about 80 to 90% mining focused. But also we have, in our mandate, farmland, forestry, aquaculture, dairy, geothermal, really anything that falls into the natural resource mandate, and any of these, materials or goods that are the building blocks for our 21st century life. So it's a real joy managing the partnership. I have a lot of, I guess we have close to 30 investors at this point. Everybody has locked in their money for 10 years, which I really appreciate. People are taking a long-term view here. They understand that this is such a volatile and cyclical space that it's essential to take a long-term time horizon and really look beyond the current cycle. So, it's been a rough 2018, and I think it has for most of the investors in the natural resource space. But I'm seeing green shoots just in the past couple months here, and I think the next 12 months could be very exciting for the space, both for battery metals in particular and the metals complex in general. So remaining optimistic here, and we're well positioned for what 2019 will bring. Okay,
we'll be sure to point the compass over to mjgcapital.com. And do you have a Twitter that the folks can follow you at?
Yes, I do. My Twitter is Geiger Counting. That's my Twitter handle, a play off of the uranium detection device, the Geiger counter. So you can find me on Twitter at Geiger Counting as well. I really enjoyed being on the program for the first time, and I look forward to future discussions here as the trends we discussed continue to evolve. Appreciate it, Patrick. Really do.
We appreciate your time also, Matt. And we thank you for coming on the show. And it's been an absolute pleasure speaking with you. Thank you very much.
All righty. Take care.
That was Matt Geiger, managing partner of MJG Capital. For more of his insights on the resource sector, please visit his website, mjgcapital.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.